You've been there, right? Scrolling your feed, you see pictures of friends at some, I don't know, exclusive party, or maybe raving about a meal at that new place downtown. And bam, that little pang hits you. That feeling of, oh man, I'm missing out. It's that gut reaction, you know? That urge to be part of it, even if you weren't thinking about it 2 seconds before. We all kind of know that feeling. Okay, let's unpack this a bit. What if that same really powerful feeling wasn't about missing a party, but missing out on like potential money? Imagine seeing a stock everyone's talking about. The price is just shooting up. Stories everywhere about people making quick cash. Suddenly, that urge to get your money in there feels overwhelming, doesn't it? Today, we're doing a real deep dive into a fascinating study. It's from the Golden Ratio of Data in Summary Journal by Heriani Idris, and it looks squarely at the effects of FOMO on investment behavior in the stock market. So our mission here is to pull out the really key insights from this research. We want to help you understand how these psychological, these emotional factors are quietly, or maybe not so quietly, really steering investment choices. What's actually at stake for your own financial future when that fear of missing out takes the wheel?
Yeah, and what's so interesting is how behavioral finance, the whole field looking at why investors make the choices they do, the psychology behind it, and how that really intersects with something so, modern, like FOMO. This study hits that nail right on the head. It's not just saying FOMO is a thing, it's digging into how it actually changes what investors do in the market. It's really exploring that very human, sometimes irrational side of things. So the main goal of Idris's research was pretty specific, to really look into the connection between this fear of missing out and some of the main behavioral trends we actually observe in the stock market. Trying to put some numbers on FOMO's influence, move past just stories, and get to the data on how it shifts investment choices.
Right. So we get FOMO in everyday life, concerts close, whatever. But how does that feeling, that anxiety, translate specifically to the stock market? And why does the study say it's such a big deal? Powerful enough to make people act, irrationally. Have you ever felt that yourself? That intense pressure, that feeling you have to jump on a stock because it seems like everyone else is winning?
That rush you're describing, that's exactly it. The study shows pretty clearly that FOMO significantly impacts investors because it ramps up their emotional reactions to what the market's doing. It's not just a small worry. It's like an emotional wave that can just wash over rational thinking. And it pushes people towards making impulsive decisions that don't really line up with sound financial planning. The study suggests this emotional boost often connects to deeper biases we all have, like loss aversion, for one. That's huge here. The thought of missing out on a potential gain can feel way worse than the actual pleasure of making the same amount of money. So when a stock is climbing, the idea of not being in, of losing out on those profits, that becomes incredibly powerful. And then there's social comparison theory too, right? We subconsciously measure our own financial success against others, often based on these perfect highlight reels we see online. It's a measurable shift in behavior, and it can really work against your long-term goals, pushing you towards those quick, risky bets instead of focusing on solid long-term financial health.
That's a really good point, comparing ourselves, plus that fear of missing out on gains. So, okay, this is where it gets super interesting for anyone investing. Beyond just being a feeling or a bias, what did the research actually identify as the main, observable things FOMO makes investors do? What are the concrete actions that change portfolio results? What do they really involve?
Exactly. The study didn't just talk about feelings. It looked at specific, measurable, and often, frankly, damaging trends. It directly linked FOMO to behaviors like overtrading, speculative investing, and even contributing to asset bubbles. These aren't small mistakes, There are significant changes in how people invest that can seriously impact their financial well-being. Let's maybe break those down a little. Overtrading, for instance. That's not just buying and selling, it's doing it too much. Often driven by that constant worry about missing the next big thing or trying to perfectly time the market bounces, which, let's be honest, is incredibly hard. Every trade costs money, commissions, fees, maybe taxes. It just eats away at your returns. The study suggests FOMO makes investors chase every little market movement instead of sticking to a plan. And that usually leads to worse results than just being patient. Then you've got speculative investing. This isn't about buying into solid companies you've researched. It's more about taking big risks, hoping for quick, huge payoffs, often based more on hype or momentum than the actual value of the asset.
FOMO kind of creates this illusion that fast profits are easy to get. So people take on way too much risk, often without really understanding it, chasing something that might have no real long-term value. That obviously opens you up to big swings and potentially big losses. And the last one, the study connects FOMO to the formation of asset bubbles. That's when an asset's price just goes crazy way beyond what it's fundamentally worth just because everyone's buying, expecting the price to keep going up. Driven by hype. We've seen it before, right? Like the dot-com bubble. Prices get totally inflated. FOMO speeds that whole process up. More people pile in because they're terrified of missing the easy money. But bubbles always pop, don't they? And that causes massive losses for the people who got in late watching their paper fortunes just disappear.
Wow. It's actually quite sobering when you put it like that, how these feelings, these very human feelings we link to social stuff, can seep into something we think of as rational, like finance. Makes you almost feel that pull, doesn't it, that urge? And speaking of things seeping into our lives, social media, it feels like it's everywhere, influencing everything. Did this study find a direct link between, our scrolling habits and this investment FOMO and this idea of meme stocks? It still sounds kind of wild. Can you tell us a bit more about how technology plays into this whole amplification effect?
Well, absolutely. You hit on a crucial point there. The research is really clear. Social media and technology play a critical role in amplifying FOMO. It's not just a place where info is shared anymore. It actively fuels the fire, creates the perfect storm for FOMO to just explode. I mean, think about it. A few years back, where did you get investment tips? Financial advisors, maybe established news. Now, someone on TikTok or a Reddit board can potentially sway thousands of investment choices with one post, often based purely on excitement, not solid research. And this amplification through all these digital channels directly feeds into what the study calls herd behavior. Social media platforms, their algorithms are basically designed to show you what's trending, keep you in your bubble. They reinforce that idea that everybody's doing it. You see post after post about some stock going to the moon. It creates this massive sense of social proof and, frankly, peer pressure. Following the crowd like that, instead of doing your own homework, is a direct path to market swings and these speculative bubbles we talked about.
And yeah, the study specifically mentions phenomena like meme stocks. It's a really clear, potent example. These are stocks where the price isn't moving because the company's doing well. It's moving because of coordinated hype, spread like wildfire online. The research shows how FOMO, sparked and fanned by places like Reddit, totally messes with market dynamics. Investors jump in, scared to miss the rocket ship, pushing prices to levels that make no logical sense. It really forces us to ask, how much of market movement is real value and how much is just collective feeling and the fear of being left behind?
That is such an important question, especially now when it's so hard sometimes to tell real financial news from, like viral trends. And given how social media blasts this stuff out, making it seem like everyone is getting rich quick, it makes me wonder, are we all equally likely to fall for this FOMO effect? Or did the study find that certain groups are maybe more at risk, more likely to get caught up?
That's another key finding, yes. A demographic insight. The study does reveal that younger investors are more susceptible to FOMO. But it's really important to unpack why. It's not just about age itself, it's tied to behavior and the environment they're in. The main reason seems to be largely due to their reliance on social media for investment advice. Younger people grew up online, right? They're naturally more comfortable getting info and even making decisions based on what scrolls past on their screen. They might also have less experience in the market over time, maybe haven't lived through major downturns or seen bubbles burst before. So that lack of historical context can make them more vulnerable to the hype, the stories of fast gains you see constantly pushed on social platforms. They might not have developed that critical filter yet to judge if the info is solid or just noise. So it's less about intelligence and more about that combination of where they get info, their experience level, and maybe that stronger need for social validation that platforms can tap into.
Okay, so that paints a pretty clear picture. FOMO is this really strong force cranked up by the digital world, potentially pushing us towards emotional, short-sighted moves that aren't great for our finances. So what does this actually mean for us? For the individual investors listening right now, if FOMO is that powerful, what can we actually do about it? How do we protect ourselves and make smarter, more rational choices with our money? Does the research offer any solid solutions, any practical strategies?
It absolutely does. And this is where it gets really helpful, I think. The results point towards, a few different angles, strategies for individuals, but also maybe bigger picture stuff. First off, enhancing financial literacy is critical. The study really emphasizes this. And it's not just about knowing stock market basics, it's deeper. Understanding long-term investing principles, risk management, why diversification matters, how to actually look at a company's real value versus just the hype around it. Having that deeper knowledge acts like a buffer, an intellectual shield against those purely emotional reactions. If you know why you invested, you're less likely to panic or chase trends. Second, the study stresses promoting disciplined long-term investment strategies. This is the direct antidote to that short-term emotional FOMO impulse. Discipline means things like setting clear goals for your money, having a plan you've actually thought through. And then this is the hard part, sticking to it, even when the market goes crazy. Practically, that could mean automating your investments, checking your portfolio less often, rebalancing periodically, and really resisting that urge to react to every single news headline or market dip. The research backs this up. Patience and consistency, not frantic trading, are what build wealth over time. And then finally, the study does touch on broader things, systemic solutions. It mentions regulatory interventions targeting misinformation on digital platforms, which could mean maybe clearer rules for online influencers, platforms doing more to check the advice shared, or maybe flagging assets that seem to be caught in the social media frenzy. The idea is to try and make the information environment itself a bit healthier, a bit more grounded in reality, trying to reduce that FOMO-driven behavior on a bigger scale so rational decisions have a better chance.
So we've really unpacked quite a bit here. How FOMO isn't just some social media quirk, but a real, measurable force in the stock market. Boosted by tech, driving things like overtrading and bubbles, especially hitting younger investors harder. But crucially, we've also seen there are clear ways to handle it, educating ourselves, being disciplined, and maybe even looking at wider regulations. It really highlights how much our own psychology plays into our financial outcomes, doesn't it?
It really does. And while we've talked about the effects now and how to maybe counter them, the study also kind of leaves us with some big questions looking forward. It suggests we need to further investigate the psychological mechanisms behind FOMO, like what's really going on in our brains, and also explore the long-term sustainability of FOMO-driven market practices.
Yeah.
I mean, what happens if FOMO stays this strong or gets stronger, maybe amplified by whatever tech comes next, for decades? Does it make markets permanently more unstable? Or do we as investors eventually adapt and build better mental defenses? It definitely gives us a lot to chew on about where finance and investing might be heading.
It certainly does. Well, thank you for joining us on this deep dive today. We really hope this discussion has given you some valuable insights and maybe some important things to think about as you navigate the sometimes wild world of investing. Until next time,